It's an absolute pleasure to be here today with such a broad cross-section of participants at the heart of global markets. As Brian outlined, you've a really full agenda covering the most important topics in capital markets today. But my focus is going to be on the resilience of core sterling markets, the gilt repo market in particular, although the things I say have got relevance for core markets all around the globe. These markets are fundamental to the financial system and the real economy. The gilt market finances government, provides a benchmark for pricing across all sterling assets, and underpins regulatory requirements. The gilt repo market is, in my view, even more critical. It supports the liquidity and functioning of the gilt cash market, facilitates the flow of cash and collateral all around the system, and ensures the transmission of monetary policy too. This is the core plumbing that underpins our economy and our financial system. When that plumbing works, it supports stability and growth. When it fails, stress can propagate quickly. I'll start with the good news. Despite significant global repricing and meaningful deleveraging in recent months, liquidity has held up well. The system has absorbed sizable moves in yields and activity without disruption. But resilience so far does not eliminate underlying vulnerabilities, nor does it guarantee the same outcomes in future. Both the March 2020 dash for cash and the 2020 LDI turmoil highlighted how structural vulnerabilities in liquidity supply combined with surges in demand can amplify shocks and require central bank intervention. And as Brian mentioned, our system-wide exploratory scenario exercise highlighted how the structure of gilt markets impacts resilience too. While repo conditions tightened materially in that exercise, gilt markets continued to function. But that result reflected the resilience and positioning of certain sectors of the market at that time. Since then, hedge fund strategies have evolved. They've shifted from net lenders to significant net borrowers in repo markets, making them more exposed to changes in financing conditions and increasing the likelihood that their distress triggers disruption in gilt markets, particularly if net sales overwhelm dealers' intermediation capacity. Let me be clear. The increasing role of hedge funds is not a bad thing, quite the reverse. They're an important source of demand for newly issued gilts, and they support liquidity and fair pricing in normal conditions. But the growing footprint of these price-sensitive, leveraged players brings new risks, and their positioning can adjust quickly in response to shocks, sometimes amplifying volatility. And because many operate across jurisdictions and across asset classes, spillovers across markets and across borders can be swift and large. The bank's goal is to ensure liquidity provision in our core markets remains resilient in the face of inevitable market shocks. Last year's discussion paper on this topic was an important step forward, and we are immensely grateful for the industry's ongoing constructive engagement on it, and may I thank the ICMA for their role in it. That is essential to ensure any regulatory interventions that may be forthcoming avoid unintended consequence. But today I wanted to make 3 key points in response to that feedback for you all to reflect on. First, market structures have and will continue to evolve, and that should shape how we assess the case for central clearing. Second, risks from margin procyclicality in centrally cleared markets are of course real, but they can and should and will be mitigated. And third, any approach to minimum haircuts can and should consider portfolio margining so that we manage the systemic risk to core markets as efficiently as we can. Let me start with market structure. Greater central clearing can unlock balance sheet capacity, lowering the costs of intermediating gilt repo. These benefits grow as the share of central clearing increases. Participants fed back to us that netting benefits for UK repo are smaller today than they are in the US. That may be true, but they are nevertheless real. Our research shows that during the dash for cash, central clearing of cash and gilt repo would have reduced exposures on UK dealer balance sheets by 40%, boosting their average leverage ratio by 3 basis points. And that's meaningful both at the product level and in aggregate, even without a push to standardize maturity dates. Efficiencies should, of course, grow as market structure evolves, as we saw with greater central clearing in derivatives markets after the GFC. In some areas, we saw a push to harmonize contract standards or incorporate client activity in order to maximize netting opportunities. And indeed, in the swaps market, we've seen constant evolution across numerous fronts. And from the point when the derivatives mandate was announced to the point of implementation, notional values at SwapClear grew from £100 trillion to £200 trillion. And as of now, they stand at roughly £500 trillion. Now, we're not naive. Such benefits will not come overnight, and they're reliant on the development of appropriate CCP clearing models and well-calibrated regulatory treatment. Some of the feedback we got to our discussion paper suggested an expectation, perhaps even a concern, that change is going to happen tomorrow, and that would be disruptive. Again, let me emphasize, change of this kind in this market will take years rather than months, but given its importance, the discussion about the future of market structure must happen now. Many respondents highlighted the potential role of cross-margining, particularly across CCPs, in making central clearing more attractive. We're keen to explore this further, and we'd welcome further feedback from you all on where the largest netting benefits could be achieved, whether from cross-product or cross-currency netting sets. But let me emphasize, this must be handled carefully. Cross-margining can increase leverage. It, of course, depends on correlations that may break in stress, and cross-CCP default arrangements, in particular, need very careful review. Let me turn to the second topic, margin procyclicality. Some participants fed back that central clearing can amplify pro-cyclical liquidity demands. CCP models increase margin requirements in periods of market volatility by design, so positions remain prudently collateralized even in the face of shocks. But this creates a trade-off between cost, coverage, and reactivity that needs to be managed. This dynamic is not unique to centrally cleared markets. The LDI episode and the Suez highlighted similar pro-cyclical behavior in the bilateral repo market, where haircuts can rise sharply under stress, particularly from a starting point where more than half of transactions are routinely conducted at 0 haircuts. The only way is up from there. We see similar questions elsewhere in the regulatory framework, including, for example, bank capital. How much capital should we require in good times, accepting that it reduces lending to ensure that losses can be absorbed without harming the economy in bad times? These are complex questions, but the answer is not 0, as appears to be the default in OTC markets. Procyclicality can be mitigated in centrally cleared markets, As the supervisor of UK CCPs, the bank monitors margin models, and the use of anti-pro-cyclicality tools gives us powers to require changes where necessary. International initiatives also support this, including work by CPMI IOSCO to enhance margin transparency and the FSB to strengthen non-bank liquidity preparedness. Finally, let me cover minimum haircuts. Feedback suggested that near zero haircuts in bilateral markets typically reflected portfolio margining practices. To be clear, I agree that well-risk managed portfolio margining can be a good thing. However, zero haircuts may also reflect competitive pressures from powerful clients. And successful portfolio margining requires efficiencies, but needs tight legal documentation, strong governance, and stress testing to guard against historical correlations breaking down. And even if portfolios are cross-margined, it's not obvious to me that within that, gilt repo haircuts should be at zero, given the systemic importance of that market. Any design of potential minimum haircuts will take account of portfolio-level approaches. A well-calibrated approach need not increase margin overall. And of course, in a market with greater central clearing, it's possible that overall margin requirements could be lower over time. It's flashing red, so I should conclude. We've more to do, and in this area, I think we can all agree that doing nothing is not an option. We should approach reform not just as risk mitigation, but as an opportunity to build a more robust and efficient market. ICMA members contribute to this. They continue to recognize the important benefits of central clearing, including improved counterparty risk management, multilateral netting efficiencies, and potential broader liquidity distribution in stress. And that's my final point. Reform requires partnership. I encourage you to continue working with us on how market structure can evolve, how clearing models and regulatory treatments can adapt to deliver greater benefits, and how tools like minimum haircuts can be calibrated effectively, all to deliver what I think is our shared goal of more resilient core sterling markets. Thank you very much.